Hello world, welcome to Building Black Wall Street. This video is going to be on investing and defining investing and giving a brief history and an example of investing in stocks. I'm going to use a current company trading in the market to paint out how to go about looking at potential investment opportunities. I'm going to start by introducing the founder of investing. I located a picture of Benjamin Graham in the book, The Einstein of Money, which is kind of like an autobiography / focus on the key principle Graham used for investing endeavors. This is a picture of Benjamin Graham in 1964. I got the picture from the book, The Einstein of Money. I'm going to be referring to the intelligent investor to use the definition Graham gave us to define what an investment is. In the intelligent investor, Graham defined investing by saying, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. So in a nutshell, that's the definition of what an investment is. He goes on further to point out in the next sentence what an investment is not. He says, operations not meeting these requirements are speculative. Graham continues by pointing out, saying this definition has some implications of a non-traditional sort. It permits us, for example, to include under the title of investment the purchase of non-dividend paying stocks or even defaulted bonds if the buyer is sure that they will eventually work out at a value well above their cost to him. In such a case, the satisfactory return would come in the form of a capital gain rather than of regular income. Graham finishes off the intelligent investor with the key concept behind investing. In the last chapter, he talks about a margin of safety as the central concept of investment. Graham wrote, confronted with a like challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. And I'm going to do a video on margin of safety separately because, as the title of this chapter points out, it's the central concept of investment. Now I'm going to read from the essays of Warren Buffett, Lessons for Corporate America, to give Buffett's vantage point on what an investment is. Just want to point out this is my favorite book on investing. It is a wealth of the most important information involving or related to investing, and I strongly recommend it. You get this in The Intelligent Investor. If you dissect these 2 books properly, you're going to do better than majority of the people coming out of Ivy League schools, depending on your temperament also, of course. But you're going to do better than most of the finance majors out there and the S&P 500. In the essays of Warren Buffett on page 100, Buffett writes, our equity investing strategy remains little changed from what it was when we said in the 1977 annual report, we select our marketable equity securities in much the way we would evaluate a business for acquisition in its entirety. We want the business to be one that A, we can understand, B, with favorable long-term prospects, C, operated by honest and competent people, and D, available at a very attractive price. We have seen cause to make only one change in this creed. Because of both market conditions and our size, we now substitute an attractive price for a very attractive price. But how, you will ask, does one decide what's attractive? In answering this question, most analysts feel they must choose between two approaches, customarily thought to be in opposition, value and growth. Indeed, many investment professionals see any mixing of the two terms as a form of intellectual cross-dressing. We view that as fuzzy thinking, in which, it must be confessed, I myself engaged some years ago. In our opinion, the two approaches are joined at the hip. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous, and whose impact can be negative as well as positive. In addition, we think the very term value investing is redundant. What is investing, if it is not the act of seeking value at least sufficient to justify the amount paid? Consciously paying more for a stock than its calculated value in the hope that it can soon be sold for a still higher price should be labeled speculation, which is neither illegal, immoral, nor, in our view, financially fattening. I'm going to be reading from the Einstein of Money to introduce intrinsic value and also to build on the margin of safety. Graham says the mechanics for determining the intrinsic value of equities can vary according to various factors. However, for the purposes of this chapter, an outline of Graham's primary evaluation methods is appropriate. Graham believed that if the per-share figure of a profitable company's current asset minus all its liabilities, which is net current assets minus net liabilities, was more or less equivalent to the share price that was indicative of a satisfactory intrinsic value relative to market price, that is an acceptable margin of safety. To sum it up, what Graham is pointing out is if that the market value, so that's how much the company would be worth or trading at in the stock market, is less than the intrinsic value, which would be the value of all the assets of the company minus the liabilities, or what that company could sell all its assets for, then you have a margin of safety at whatever percentage is in between the market value and the intrinsic or liquidating value. If you want to really get deep and get a better understanding, I will highly recommend you get these 3 books and really dissect them. For my next video, I'm going to be using this CNBC financial information on Walmart to really point out the margin of safety and also give a better understanding of what an investment is. So I hope you tune in, stay blessed, and stay tuned. Peace.